Welcome to the Gray Report. I'm your host, Spencer Gray. Now, again, if you're a multifamily investor, an aspiring investor, or you just love the idea of creating passive income, generational wealth, we'll strap in because we've got an awesome show today. We've got Matt Bosnagel. He's the director of marketing and communications here at Gray Capital. He's the one that puts a lot of time putting the Gray Report newsletter together. He's with us. We're going to be breaking down what's in the latest edition of the newsletter. Went out April 22nd. 2021. A lot of new happenings, and I think Matt has had a couple predictions that have ended up coming true. Matt, it's great having you on the Gray Report. How's it going?
Pretty good. Actually, everything I said was true, and I'm really gratified this week that I don't know. It just seems like when a lot of the same stories are happening for 3 weeks in a row, it's not too hard. It's not too hard to be right.
Yeah, no. Well, that's a trend. If
Yeah.
the same thing's happening over and over again, there's definitely a trend line there. So, again, I guess first, let's get everybody up to speed on what the Gray Report newsletter is, what it's all about, and then we can kind of get into some of the articles and what's going on.
Yeah, so the Gray Report, it's been running for a little over a year, and it comes out every Thursday. It's a free report. You can sign up on graycapitalllc.com/newsletter. It's free, comes out every Thursday morning at 8:30, and it's grown from a small handful of articles that on the multifamily industry to really a larger collection of reports, research, news, opinion articles. Really everything that's important that happened in the previous week will go on that report, and sometimes even bigger picture stuff. We have a little market snapshot that covers the where the rates are going and some of the commodities and other kind of important indicators for the markets, and we really try to keep everyone on top of things. One of the goals that I had for the newsletter was really to share the most information in the least amount of time, so that I didn't want to waste any time, but I want to get all the information in there.
Yep.
So I really work hard to keep it efficient.
No, you're doing a great job. And one thing I keep hearing from readers of the Gray Report newsletter is that it really contains pretty much everything you need to know if you're tracking the multifamily industry, commercial real estate, the economy. If you just looked at the Gray Report newsletter once a week, you would basically be up to speed and current on pretty much everything that's going on. And again, I just keep hearing that same feedback as it's just got everything I'm looking for in one place. So let's kind of get into the latest edition of the newsletter. Again, came out 8:30 this morning, April 22nd, 2021. What have you got for us, Matt?
Okay, so one of the things that I noticed, kind of gathering news for this week's newsletter, and really in general in conversations with Spencer and Jay and William here at Gray Capital and Alex, is the pipeline is different than it was last year. I was going to have a big fat picture of a pipe here, but I think that's ugly, so I went with a nice picture of a multifamily building. But really, it's like there's a lot of pressure in the pipes right now. There's not a lot of outlet for the capital. A little bit slightly less opportunities in the multifamily world, and a lot of buyers hunting for those fewer opportunities. Now, it's not like single family homes, which have really been under a crunch, and that's something that we've kind of followed since last year. Is how surprising the single family homes have stayed healthy, that market. And that's kind of the story right now, is that there's the money's moving, but it doesn't know where to go yet. And we need there's things like there's a lumber, the story about lumber prices and steel prices are going up, and we're just waiting for things to come back online, I guess.
It's interesting. You kind of phrase it like that, of just because it's true. There's just so much money that's out there. There's so much capital that either was sitting on the sidelines, and then there's just new money. There's been money that's been created since the pandemic, and it's looking for a place to go. And, it's been going to the stock market. It's been going to real estate, but it's also been going into, Bitcoin, NFTs, Dogecoin. They're finding all these crazy places to kind of find themselves. Not that multifamily is the crazy place, more of some of those other alternatives. And because there are, like you said, there's a ton of demand. There's so many buyers out there looking for quality multifamily assets at somewhat reasonable entry points. but there are very few deals. And I think that we've got a chart about kind of transaction activity and volume, and
Yeah.
we're way below what
Yeah,
was going on in the last last few years. But it's not like that demand has decreased
Yeah.
by any means. If anything, it's increased as
It's that is, yeah, that is really interesting how, you see that the moment right here on that end of that chart. There, the volume and the tightness is there. We're just surpassing it because there's so much demand, like you said.
Yeah. All right.
And and another thing too that kind of more on the big picture stuff is we were talking. I remember writing these newsletters and at the height of the pandemic last year, and the story that I kept writing every week after week was how many people are stuck in the wait and see mode. How
Yep.
many people are on the sidelines still waiting to move. And I said, guys, come on, let's move. And now they're moving too much, it seems. So
yeah,
so
no,
it's,
no, you're right. I don't know how many times I heard last year that, okay, we're just going to wait till Q1 2021. We're going to wait till 2021, see what the landscape is like, and then we're going to start making decisions whether we're going to buy or we're not going to buy. And I think people kind of put that mark in the sand pretty early on in the pandemic, even when there were good opportunities. If you were halfway confident about the future, but people had just kind of made their decisions to sit this one out. And as we touched on the cap rate interest rate video that we recently did, and looking at that opportunity that was pretty short-lived during 2020 when interest rates were just bottoming out and cap rates really hadn't moved that much because that wasn't that much price discovery that was going on, and we were at an all-time cap rate interest rate spread, over 500 basis point spread between the 10-year treasury and the US national average cap rate. And the 10-year treasury has come up basically 100 basis points from the low. I mean, it bottomed out at around 50 basis points, and now according to the newsletter today, the 10-year treasury is at 1.58, and cap rates have come down at least 100 basis points. And so between 100 basis points of cap rate compression and 100 basis points moving up in interest rates, that's a 200 basis points decrease in the spread. So that definitely is making deals more difficult. So it's definitely a different environment.
Yeah, and that's the open question that I've kind of been thinking about is, we know that we knew what to do last year when we knew that the market was great and people weren't acting. We could just kind of take an action. But then what do you do when in a situation like this where there's so much demand, and what kind of action can you take to kind of take advantage of it?
Yeah. Well, last year there was just so much, perceived uncertainty. And I think the difference is, we were more certain than I think a lot of other groups. We saw, the clear supply demand imbalance. We saw what was going on in our portfolio, that we still were seeing performance. We were still seeing relatively strong rent collection, occupancy tightening, and we just didn't see the bottom following out. That gave us the certainty to kind of move forward where others just probably didn't see it. Now there is so much certainty in the market. Multifamily performed very well during the pandemic. Now everybody is just, flooding into the space, and there's just fewer and fewer opportunities. But what we're weighing that all against is the picture of inflation and rent growth. And as inflation picks up, rent growth typically beats out inflation. But it's how much inflation, how much rent growth, and are we going to see elevated numbers for a very short period of time? Is it going to be very transient? Boom, high inflation, recover in GDP. I mean, because there's, I think, our annualized GDP for Q1 was close to 8%, and that's massive. But compared to 2020, when we saw more than an 8% decline, we're still wondering, is it really inflation or is it really reflation? Then with all these supply bottlenecks, again, is it a transitory increase in prices, or is it more long-standing? But even if it's short term, we're going to elevate prices, especially rental prices. It'll probably kind of remain elevated just because it's much harder for rents to come down. The trajectory is usually upward, and they really only come down if there's a decrease in demand, and we're just not seeing that decrease in demand whatsoever.
Yeah, that is something that that is worth repeating is that is really the resilience that multifamily has had throughout the pandemic, and all signs really point to growth in the area. You really can't. It's not that you can't go wrong, but it
Oh
just
yeah.
there has the story of multifamily, especially in the past year, has really been a story of kind of strength and endurance. So
Yeah.
um,
No, it's not like you said, it's not like you can't go, it's not like it's impossible to go wrong. I think that the risk is equally, you can overshoot the projected growth and inflation, and you can undershoot it. If you undershoot it and you write too conservatively and you still use 3% organic rent growth for like the next year, it's going to be very difficult to, win any opportunities to pursue, any deals. But you also don't want to be careful. You want to be careful not to overshoot your rent growth. And, yeah, maybe we'll get a, 6, 7, 8% rent growth maybe in your market, a new acquisition. But what if it's only, 5 or 6, which is still strong rent growth? But if you're underwriting, 10 to 15% rent growth, you could end up, you could be left holding the bag of something that really
yeah.
doesn't support the price level that you purchased at. So that's what everybody's trying to figure out, and nobody has the answer on it. But
Yeah.
trying to find that sweet spot, not overshoot, but still be competitive.
Yeah. So actually, that may or may not lead into the general kind of conditions that this snapshot reflects. Is there any specific number or figure there that kind of stands out to you, or that's something that we should watch here?
Well, you mentioned lumber, and everyone's been talking about lumber. Basically, it's at $1,300 for, I think what's that? 1,000 square feet, or 100 square feet of lumber. So I mean, obviously, that's up 200% year over year. To us, that is directly going to relate to higher replacement costs. It's going to be more expensive to build new construction, new product, new apartments. It's also going to be more expensive to renovate apartments. And what that's going to translate to is not only higher replacement costs, higher costs of new construction, but the rent levels for that new construction are going to have to be elevated. And so where you may have had a brand new apartment, for example, trying to hit, $1,200, average rent levels, maybe they're shooting for $1,500, maybe even $1,600, because they have to price those costs. And we're kind of seeing that increase through prices throughout the economy. And so with rents usually outpacing inflation, it makes sense that they would also be increasing in line. And so again, just looking at a lot of those input costs, whether it's lumber, whether it's steel, crude is a much more, general, barometer, but there's a lot of products that are, made from petroleum, from crude oil. I was having a conversation, with some, real estate colleagues, and actually it's going to be, they're working on the build out in our future new office space. And there's a indoor climbing gym that's going in, that's going to be a tenant, and they've got all this foam that they need to put in, all this foam for the bouldering area, and they can't get the foam because of the increase in crude oil, and then
Wow.
that freeze down in Texas where all the oil production was going on, and
Oh,
this foam
wow.
is a byproduct of petroleum. And so there's all these, it's not just gasoline, it's all these byproducts of
Yeah.
petroleum, and there's all these little supply bottlenecks, whether it's it's in oil, whether it's shipping and container ships, the Suez Canal. We keep hearing just about all these supply bottlenecks that are increasing prices, and they're just adding on the inflation pressure. But again, all of those could be transient effects because they're short term. Price increases. You'd think once the supply bottleneck is figured out, prices should stabilize. But sometimes short-term transitory effects catapult us to longer-term inflation. I mean, that wasn't the only cause of inflation running back in the 70s, but the oil embargo and the oil crisis back in the kind of the early 70s was certainly a trigger for that higher inflation that we saw during the 70s and early 80s.
Yeah, it's really interesting. Even within the country, there's different regions are recovering at different rates, and that's got to have an impact on logistics.
Mm-hmm.
If some people aren't working yet at the sawmill in in Washington State, then maybe it. I don't know if that.
Yeah.
Yeah. Yeah.
No, and then that's the story, is that it's not necessarily we don't have enough trees or like the actual wood. It's just the sawmills didn't have the people making boards. So yeah, it's a good point.
Yeah. So, okay. So that's kind of the rates and markets. And we can go in detail if you'd like to any more, but
No,
that was
I
the
mean,
highlight that I saw is,
outside of
Mhm.
no, I mean outside of crypto had a flash crash over the weekend on Saturday, but Ethereum is pretty much recovered, and things are mostly recovered, and that's not really related, but it's just something to point out. But
it's 2021. So I think it's worth, it may be
well,
worth mentioning.
yeah, I mean Dogecoin. We don't list Dogecoin because I don't know how it relates to. I don't know
I think I
what
got to
that
draw the
tells about
line somewhere.
anything. I think it's the that's like the insanity,
Yeah. Ooh,
index.
the insanity index. That's a good idea. I like
Yeah,
that.
but I mean, it's up like I don't know, however many thousand%. So I think it was they were shooting for like on 420, they were shooting for 69 cents or something like silly like that. I don't
It's
know
a
if it
symbol.
happened.
What a
Hmm.
symbol.
Yeah, yeah.
All right.
Anyway,
So
so let's get into some of the
yeah.
articles.
So I started off with what I thought was a dramatic and I'm not sure if it's a likely situation, but these are kind of the discussions that are happening in the House and in Congress is this Green New Deal for public housing, which would give $100 billion over 10 years to public housing and renewable energy. Um, I think it's significant for the amount of energy they're pouring into housing. I'm not sure what regulations or any kind of strings attached, or even kind of how they would manage the funding for that bill. But I thought that it's interesting. All of these, the infrastructure plan and even the CARES Act too. They have a lot of money earmarked for housing, and the budget and even Biden's campaign platform, it mentioned affordable housing, which I think is going to be a really big deal, and something that people will only start to talk about. Right now, people are saying infrastructure, they're saying jobs because they've named the infrastructure plan the jobs plan. But I think that it's only a matter of time, and frankly, they're even talking about it now. Is housing and affordable housing specifically. So
Hmm.
I think that's
Yeah, I mean, it's obviously a hot button issue. There was a housing crisis before the pandemic, and there still is. It's just again, like the federal government is more concerned about appeasing in politics rather than I feel like actual solutions. So I'm pretty skeptical in terms of the central planning coming down from the federal government, which in general it's just why the infrastructure bill to me is just a little concerning, because it's less infrastructure and it's more just central planning and the federal government believing that they know the best way to allocate resources for the economy rather than letting markets do that. And I'm just highly skeptical that 100 senators and however many couple hundred representatives really they know what's better for the economy, rather than a couple 100 million individuals and
yeah,
businesses can figure it out. So pretty skeptical. I'm sure some of the
yeah.
spending is needed, and we certainly have major infrastructure problems, but it really seems like about 2/3 of the infrastructure bill has nothing to do with infrastructure, and then the housing piece. We definitely have an affordability problem in the U.S. A lot of that can be solved with easing kind of zoning restrictions in some of
Mhm.
these areas. I mean, it's the Californias, it's the New Yorks that are really having this problem with public housing. It's because you can't build anything. We're not building
Mhm.
enough housing. So
Yeah, that will be interesting to see how, because affordable housing means a lot of different actions. It could mean, it could be mandates it could be rent control, or it could mean making the tax environment very favorable for investors.
yeah.
I kind of hope for the latter, but we'll wait and see what's more popular. It is unfortunate that they can't that it is several hundred people making these decisions for the million for sure. Okay, so the next article is, well, the next kind of few articles really talks about this general feeling, and again, this is I'm not trying to kind of name a zeitgeist or describe the pulse of America, but it does seem like things are turning around. says Q1 was a turning point for commercial real estate, and this CRE platform Crexi has noticed a lot of things are going on the market and a lot of buyer activity. And this is the same. It's interesting. It's the same figures basically. So this 24% listings increase. Well, the buyer activity has just leaped up to grab all of that. 25% of buyer activity, which is almost a mirror of this. The sales volume's up and the market tightness is up.
Yeah.
So things are coming online, but there's more demand still to kind of beat that up.
Yeah. It would be nice to see if they had not only the quarter over quarter, but the year over year data from that, because, we just went from, again, like we were just talking about, so many people were on the sidelines last quarter. It can be a big jump up from, next to nothing, but it's definitely it's good to see that for the deals that are coming online, there are buyers lining up. And then I'm assuming it's just across commercial real estate asset classes. It's not just multifamily. And so that's even for, the office buildings and the retail centers that are coming online. There are buyers that are more or less willing to pick some deals up. So it's good stuff.
And the same thing in a little bit more expanded and a little more detail is this Marcus and Millichap short report that talked about all of this. Again, like I said up, summarizing things. There's a lot of liquidity. There's just not enough opportunities to kind of unload that. And so it's higher pressure in the pipeline. Industrial and multifamily, again, remain the darlings. And it's interesting. I was going to try to characterize multifamily over industrial, but it does seem like multifamily is a story of stability and resilience, rather than industrial seems like this kind of a lot more excitement and exuberance in the market when compared. But I'm not sure what's your opinion on comparing? Do you see similar activity in those two markets
for industrial compared to multifamily? I mean, industrial, without a doubt, has probably been the most unscathed, agnostic of location, just between all the e-commerce and, online shopping and needing for fulfillment centers. I mean, one of the reasons why steel and lumber have gone up is because Amazon's been building so many fulfillment centers. There was no issue of, people needing to be evicted because they lost their job. In terms of industrial, people were shipping. Now, that doesn't mean some industrial, tenants didn't have some issues, but for the most part, it was very solid, and it's been a very solid investment thesis for, quite some time. And I don't see e-commerce slowing down anytime in the near future. I mean, maybe we can get over our skis in terms of building too much, warehouses, industrial space, but I don't see that happening in the immediate term, at least.
All right. So kind of moving on, there's another, Housing Wire does a good job of tracking a lot of the mortgage market. And they've noted that as mortgage rates have fell, applications have picked up, refinances have picked up a little since last week too. The market is not going to let mortgage reduction, the reduction of rates pass by without.
What I find this interesting is just how sensitive the market is to interest rates. It's just because if they can borrow that much more house, and again, people are buying a payment, they're not necessarily buying a house. And if they can buy a little bit more house because their payment's going to be less, because it's not like rates have dropped dramatically since they ticked up from the lows. But and it's not like buying completely stopped, but you can definitely tell just of how much volume that's going on, just how sensitive buyers are. Yeah.
And then we get to an article from a report from Cushman & Wakefield about inflation. And this was interesting just because I've been thinking about inflation a lot, especially after all of these these bills have been passed, and there's a lot of government spending. The economy is starting to wake up. People are starting to spend more. I think it's kind of natural for people to start discussing inflation. But all of the significant articles that I've read have really said that that it's not going to happen. That's not going to make me not stop think. That's not going to make me stop thinking about inflation. But it does kind of soothe my fears a little bit that there probably will be inflation, but it's nothing that can't be kind of absorbed by the market, or it's something that's not kind of due for the market.
And that's my gut, and that's my thought also. I don't think there's any question that we're already seeing some degree of inflation, and I mean, it comes back to how much of it is reflation and inflation, but we're already seeing elevated prices. I think, like we've talked about, how long is it going to run? And what I think everyone is forgetting is just the massive deflationary pressures of technology. And like, we're in a different part of the market cycle, but that doesn't mean those deflationary effects like have gone away. It's just we're just valuing that technology slightly differently. And in technology, advancements in technology and human innovation don't necessarily always follow a market cycle. And as we develop new technology, that is going to have downward price pressure on certain things. Now, probably not housing, probably not certain parts of the economy, but other parts of the economy certainly. So I'd agree. I think we're going to see elevated inflation maybe for the next year, 2 years, but I don't think we're going to hyperinflation by any means. And even if it is just a transitory, lift, it's at least going to plateau up to that higher level for many prices.
Yeah, and it's been something that even before the pandemic, people were talking about inflation and the low rates, and they were trying to create this story that never quite panned out.
Well, yeah, I've been talking about it since 2008.
Yeah,
doom and gloom, and there's hyperinflation, and we had Peter Schiff, running around to buy gold because hyperinflation is on the doorstep every couple months. And
so in these articles that you'll read about inflation, that's always a running side story is like, yes, we acknowledge that we've been talking about this for a long time and it hasn't happened, and we and no one can quite figure out.
Well, it's kind of like the boy who cried wolf. It's you say it so many times, and now all of a sudden we're like, yeah, okay, it gets an eye roll now. Okay, hyperinflation's coming. It's like, yeah, okay, sure it is. So you can sell some more gold or whatever you're selling at this point in time. But that being said, it's not like traditional economics like just don't exist and they never worked. And I think there is a lot of people, and I honestly go back and forth because I don't know who no one knows for sure, but the proponents of more modern monetary theory and just more classical Keynesianism of like, hey, we can just keep spending, we can keep printing. If inflation shows up, okay, let's deal with it then. But like, let's just keep spending until it does. And maybe it never will because of technology.
Magic?
Yeah.
Technology.
Same. I mean,
I guess so.
What's the difference?
So the other are the next kind of few articles talk about lumber.
Yeah, which we'd already talked about a little bit.
Yeah, I thought crazy. Yeah. And green legislation. I think that kind of folds into a little bit of what do they call it? The Green New Deal for public housing impact. I think that I'm not advocating, any political decision because I'm not that smart or stupid enough to advocate a political decision. But I do think that it is worth watching. The administration and the people that are in power right now are probably going to favor policies that are more, that have these kind of green alternatives and green buildings, whether it's electrification over gas heating and cooking, or it's kind of some kind of carbon footprint legislation or something. This is something that's just like inflation. It's worth watching. It may not happen. I think that that a lot of these plans that you see are first of all, they're very localized to specific markets, and within those markets, that is something that people are aware. They can kind of see it coming ahead of time. So I think it's interesting, and it is a consideration for these markets, like maybe a Seattle or a Portland, or that may kind of require a little bit more regulation when it comes to kind of construction, development, and renovation.
Yeah. Well, and some of it's already going on. I mean, we've had, the green programs from, the agency lenders for a while, giving reduced rates for their green programs. HUD has a green MIP program, but also it just makes financial.
The next few articles, it talks about premium movie theaters and mixed use projects, which I thought was kind of an interesting idea, just because theaters have been hit so hard, and mixed use is also another. It seems to go up and down. It seems like every other article is either, oh, this is a great idea, or, oh, this is a bygone idea. But I do think it's interesting that these theaters that have not done great, moving them into mixed use and generating kind of foot traffic to the retail.
I'm just curious if like they have enough information to say whether that's really happening or if that's just like their idea,
It is. Intuitively, it would be so fun to live somewhere and go right downstairs and go see a movie.
Sure. Yeah.
But that's
I know. But then it's like, do you have people who are just like, I can just, if I can watch the movie in the comfort of my own home, I'll go down and I'll buy a bucket of popcorn from the movie theater. I'm going to go back up to my apartment.
That's like the reverse of what usually happens.
I know. Well, I know, right? Well, I was with someone this last weekend who has done that. They would go into, or they're doing that now. They'll go into a movie theater. They'll buy the like extra large bucket of popcorn, for just the popcorn though, for like, $5-6. And they're like, it lasts for like 3 days, and then they go home and watch the movie at their house.
That's really funny.
I mean, like, you could probably make the popcorn cheaper, but it's hard to get the same
the feeling,
standard, the movie theater, popcorn. And so I agree. I mean, I think, kind of the experiential consumers and retail still is going to make sense. And movie theaters were on their way, making a lot of progress, making the experience better. Most of them you could have, a glass of, pint of beer and, cocktail or whatever. And some have better food and the seats are better. But, it's still like, if the movie's going to come out direct to Netflix or Amazon or whatever, I think that the big blockbusters you still want to go out and see, like, if like Star Wars or the new Marvel movie comes out and you want to see those big action scenes, like, I get it. Let's go to the movie theater. Or, if like, if someone's coming out in, like 70 millimeter or something, you want to go see it at the IMAX. Like, I get that. But just, hey, in movies that, do you want to go see this new rom-com over at AMC? Like, they'll probably pass.
It is interesting though to think about what, because I do think that the kind of retail real estate is such an important part in the character of a neighborhood or of an individual development. And it would be interesting to look into what is the ideal tenant for. Is it an H&R Block or is it something exciting like a movie theater? Just kind of thinking about how that commercial / the retail side of things affects the residential is really interesting. And it's something, you factor it in when we're thinking about multifamily.
And what are the things that like you have to do in person, and what are the things that like you don't have to do in person, like a nail salon, a barber, a restaurant, and even a restaurant you get delivered. But a lot of stuff, it's like you're probably not going to have the nail salon come to you. You're not going to have it like buying it through Amazon. But like an H&R Block, like you can do all your taxes. Like, you don't need to go in and show a tax specialist at H&R Block your W-2 or whatever. You can email it to them or whatever. You can do it all on from your phone. So it's, what's going to be necessary and what are the kind of experiences people want. But then it's like, what's essential to actually do in person, and what people they could do it online, but they want to do it in person. There's certain things that you still want to go touch and feel. So I think there's going to be bifurcation, and it'll be interesting how it shakes out.
Yeah. So the next article talks about landlords and tenants and rent relief. This kind of ties into an earlier discussion you've had, and we have a blog post about this, about the eviction moratorium, and it just highlights the difficulty that is coming. And there's another article down here that talks about what to do about kind of preparing for the unwinding of the eviction moratorium. And this is just, it takes some kind of examples, talks about how some tenants are not really taking advantage of the rent relief programs. Some of them don't qualify for the eviction moratorium. There's just there's going to be a tangle of problems that are coming up. And it was interesting, the article that I'm referring. So they're not typing rent relief, but then there was another article also in the newsletter. And that second article talked about eviction really as a last resort. And it said, yes, you don't want to, no one wants to evict their renters and no renter wants to be evicted. But from a practical position as well, even if you were very heartless, you should really think about how things are going to get clogged up when it comes to eviction once this moratorium's over, and there's probably a better, more effective solution.
Yeah, no, I mean, we've had some, I guess there's a couple of points. One, it's true. Some tenants, some residents, they don't want us help or assistance, and there's really only so much you can do. And it's true. You really don't want to evict anybody. It is kind of the last, the last thing that you'd like to do. And so many times, because it's a process, you have to go to court. And especially if like they actually want to fight it. And we've had some residents who like, they could pay, like they didn't lose their job. They just didn't want to pay rent anymore. And it's gotten to a point, especially some properties, we're like 98, 99, 100% occupied. And we're like, I've got a list of people who want to live there, and you're not paying me. We'll pay them to leave. It's like, look, we'll give you, here's $2,000. Like, thank you. But can you give us the space back? So it is, it's challenging and it's disheartening. Some residents are doing everything they can. And then it's the ones who we see taking advantage of the system are the ones who have the ability to pay, they're purposely just taking advantage of the system. They're not necessarily hurting. And then unfortunately, a lot of those who need the assistance, they just don't want, they don't want any assistance. And it's hard to figure out what to do in that type of situation, because it's like, you can bring a horse to water, you can't make him drink. And again, at the end of the day, we have to operate our business in a somewhat profitable way.
Yeah. No, I think that's true. And I think I do think that it is, it's worth mentioning. No one wants to evict someone, but I also think that some landlords are going to be different than others. There are some landlords that may evict people at the drop of a hat. And those same landlords, my feeling is that they're not running the most efficient shop anyways.
The bad landlord who locks their resident out after they've missed a day or something. Those are they own a handful of units, and they're kind of running and gunning. They don't know what the rules and the regulations are. They don't know about fair housing, and they're just not sophisticated or professional. And it's like a very small percentage of landlords, but they obviously give all landlords a bad name. Most professional organizations can't risk dealing with being out of compliance for fair housing, and are so focused on doing things the right way. But you also have to treat everybody the same. That you can't if you give one person a pass, you have to give everybody a pass. And so you kind of have to set the rules and the borders at some point. And then, if you break in, you don't pay your, honor your lease and your contract for, months on end, what do you expect the landlord to do?
Yeah.
So,
yeah. The next was another kind of a rehash of the infrastructure plan. Basically talks about the affordable rental housing. And then I want to get to this, the Nmhc quarterly survey of apartment conditions. And it's just a really short survey actually. And it three basic questions. What is it here? Are the local markets tight, or are they looser? And then question 2 is, what about sales? Are they higher or lower? I'm sorry, there's 5 questions. What about financing? Something about the conditions for borrowing. And then, are you receiving back rental income from rent relief money? The ones that I highlighted in the newsletter were that overwhelmingly the respondents found apartment markets tighter. Now that's That's 67% in April. And I've got the article up right here. In January of this year, it was at 16%. And then in October, the previous quarter was at 18%. So really things have turned around. That article, it really has turned a corner in Q1. And that was the first article that I read when I was putting the newsletter. I was like, okay, here we go.
Yeah.
So it's exciting.
It is. It makes things difficult from the buy side.
Yeah.
But yeah, no, April 2021, the market tightness index, I mean, it's at 81. And like you said, that on the index from January, it was at 43. So almost a doubling of the index. That's a significant jump. And I'm trying to look back. I mean, there's not a point since 2017 here where it was above 60 on their index. And so that's, we have to go back, really just looking at that graph in the newsletter, we have to go back to 2010 to see a point where the market was as tight as it is right now. And, sales volumes are still, relatively low, although sales are they're picking up. So
interestingly, for the tightness, the market was tight at 16% in January 2021, and then the same numbers. So people didn't feel like the market was tight in October 2020, but the sales volume in October 20 was 60%. So it was the same sales volume, but the market is what, 59% or 40 or 50%, bigger than it was.
Yeah. And that comes back to what we were just talking about earlier, is just all this capital is coming off the sidelines and it's trying to find a home.
Yeah. So the next article covers these top 5 markets for occupancy growth. And I thought what was interesting about these markets, and this was a measurement of through kind of February, the occupancy of the year over year, I'm sorry, any growth. And these are all smaller markets: Anchorage, Lafayette, Lake Charles, Macon, Inland Empire, Corpus Christi. Corpus Christi is really kind of an independent. It's not really close to anything else in Texas. And it's also worth mentioning Lafayette, Lake Charles is in another article about it's one of the number 1 markets for Gen Z renters. And I can, now that I'm talking about it, these Gen Z renters it says they're ditching the city in favor of vibrant suburbs, but they define vibrant suburbs as just smaller towns, I guess, or smaller cities.
I'm still, what's the draw to Lafayette and Lake Charles, Louisiana?
I don't know. That's what's interesting.
It may just be, and I'm just reading the article right now from Multi-Housing News, is that it look maybe in Lake Charles, it's because they're really just judging this based on occupancy growth. They mentioned that there's been population growth has been slow in recent years, and that therefore development activity has decreased, and so just less supply has come online. But there's still enough demand, and so there was a little bit of a miss from developers that could have probably developed a little bit more than they actually did. And again, that's what's been leading to the supply crunch and rent increases and occupancy increases, is that we're just not building enough. You kind of look around, you're like, oh, there's a new apartment building there, new apartment building there. Wow, we're building all these apartments. Okay, so you added 400 units, but you really need to supply 1,000 units.
Yeah.
To keep up with demand. And it's not happening. At least it is in some markets, but off the radar markets, maybe like a Lafayette, Lake Charles, Louisiana, but for like an Indianapolis that has still strong and growing population growth, we're building, but we're not building enough.
Well, and that's interesting. And I'm using any kind of segue that I can to bridge these different articles. But I do think that it does play into this article about resident migration, or this report about resident migration patterns. If you get a little bit of movement in a small market, that's going to matter a lot more than if it's in a big market. So maybe the slightly more interest from Gen Z renters made Lafayette, Lake Charles, kind of really fill up in terms of occupancy. But I do think it's interesting. I think that one of the most fascinating stories of this past year for me really was tracking the movement of everyone, of people from big markets to small markets, from cities to suburbs. Some of those were true, some of those were not. There was a lot of articles that we were read in the past year that used the word exodus, and I think people love talking about exodus. It looks great on the paper. It's a great headline. I was a little bit skeptical of them, but it is endlessly fascinating to kind of tease out what's moving these people, how temporary is it, and what are the longer term trends that are going to persist after the pandemic. I know one of them was people moved to the suburbs. Now, I think that some people are moving downtown, but what this article really reflects is that it is an age thing. 20s to 30s, they like downtown. Now that millennials are getting older, that natural progression is they're gonna want to go into a place where they can get a yard, where they can get a home in the suburbs.
Yeah.
So
even if they want to stay in the city,
yeah.
it's like, even though like they like the idea of like, I like being in town, you can't find anything. If you want a yard, if you want a house that's not like, 100 years old and you have to put a ton of money into it, you're kind of stuck, okay, well, the suburbs are the only option. And then the suburbs, it's not like when we were growing up in the suburbs, it was like they were just a cornfield and you're living, in a subdivision and there's nothing around. And, maybe there's a small town with a grocery store, but you still have to go like into the city to do anything. Yeah. Now these suburbs have little, satellite cities. They've been built out. These small towns are now like little mini cities. And it kind of has all the amenities, the restaurants, the entertainment that you'd want. And so it's kind of, why do you want to live in a city? Well, so being near to things and near to food, near to entertainment, and the suburbs are checking a lot of those boxes. So it all kind of makes sense. That being said, I think the downtown is still going to attract certain folks. There's still an energy downtown that's hard to replicate up in the suburbs, but I think a lot of this it's movement on the margins and not necessarily, wholesale, everyone's moving. So
it will be interesting to see, like I said, which of these ongoing trends did the pandemic kind of ratchet up, and what is something new that came from the pandemic that may actually persist. And I'm wondering if some of these movements from more expensive markets to less expensive, lower cost of living markets is something that will linger to a measurable degree. I think downtown suburbs, that's something that's kind of more or less ingrained in our society, maybe a lot harder to shake off in a year. But when it comes to kind of cost of living, that's a real impact on people's lives. And if they can do the same job in different places, if remote working really does kind of persist, and I do think also there was a few articles in the newsletter a couple weeks back about this push-pull between employer and employee and where the workplace is going to be. And I'm not really that bullish on the flex office spaces or the hub and spoke, but I do think that that if offices are looking to relocate, and I think that maybe cost of living will become a bigger factor in what they can kind of bring to their employees.
Yeah, I think so. Yeah. Well, if it doesn't matter if your employees are actually in the office, then you can hire from anywhere. And and you don't necessarily need an office, but
yeah. And really the last article was kind of it talks about real estate developers taking on a private equity role instead of listing individually. They're having a fund model. That's something that's something that we've kind of thought about, I guess. And I just thought it was particularly relevant because this is some of the discussions that we're having at Great Capital. We can cut this off if this is too much under the curtain. But there are some benefits to having a fund rather than listing each CRE project separately. And this is some of the stuff that we've talked about here at Great Capital.
Well, it is. And I think part of it also is just the changing roles of how people invest in real estate. I mean, we're so used to being in like the kind of syndication world, and it's what's normal to us, but you have to think back. This, syndicating real estate like this is not really the traditional way that real estate is funded. It's either been a very small group of, very high net worth individuals, guys getting together at the country club and, hey, let's buy a building together. I mean, that's more of the traditional model. That, or a large institution, one investor is going to be funding a developer. And so developers aren't going around at marketing and like just part of their business model wasn't like, we're going to just be actively raising capital all the time. They would have maybe an equity partner or two. And that model still works. And there's some advantages to that as well. But now they're seeing that they can get a lower cost of capital if they're going out and raising funds themselves, either through direct projects or actually having, like we were saying, an actual fund, whether that's a closed end fund or a blind pool fund or, whatever the structure is. And with, like we've discussed, there's so much capital out there trying to get into commercial real estate. It kind of makes sense. And it allows one to be much more competitive on the acquisition side to have those discretionary funds available. I mean, if you go into a buyer interview and we were on a call for, $50+ million transaction the other day. And, when the biggest question is, where the equity is going to come from and how are you going to close on the deal? And to be able to say, we've got discretionary funds ready to go makes you a much stronger case and buyer than saying, well, I have to go and raise the money, which most syndicators, do. So if you have a fund that becomes a much less of a concern, much more certainty to close.
Yeah. And it's interesting too, from the buyer's perspective, or from the individual's perspective. If they, it kind of changes the relationship, but not really. If you want to invest in multifamily, for instance, you can go to a syndicator and invest in a specific opportunity. But as we have said on our blog and in all of our materials, it's really, you are investing in your trust to the syndicator. And it is much more important to trust the syndicator than the specific opportunity. And the fund it seems like a natural progression of that. You're investing.
If you believe in someone's ability to find deals, put the right business plan together, assuming that they don't just completely pivot and, hey, I'm going to go after apartments, and then they end up buying hotels or whatever, so as long as they do what they say they're going to do and you have trust they will, then it makes more sense. Because I think that, again, if you really trust the person who's putting the deal together, you're going to trust that it's a good deal. And with the idea of, like, for us, like, we're not, the idea of like bringing our investors like a mediocre deal is just like irks me to the core. Just one, because it's like, I'm investing in it also. And like, there's like, you're going to get a fee, but like, how long can you keep that going if you just keep throwing out mediocre deals? Like, no one's going to invest in your deal, and it doesn't get me excited. That shouldn't get anybody excited. So if you're working with the right sponsor, they should be bringing you the right deals, but that involves bring that trust level up with that syndicator, with that sponsor. So.
Yeah, that is something that I'm always kind of interested in. What kind of deals? This would be an interesting question to ask a syndicator. What's the most recent deal that you've said no to? Or what did you have to walk away from? What'd you feel, how'd you feel about it? And kind of what were those terms would be really interesting, because I do think it is, it's as much the deals that you say no to as it is, the ones that you find.
Well, and any like serious syndicator should have like a very long list of deals they've said no to. If you're just like saying yes to like the deal that comes across your plate, that's a major red flag. I mean, we can show you the theoretical garbage can of deals that we've had to go through to look at the few opportunities to make offers on, and we haven't won any deals yet. And because the purchase,
some sting more than others, though.
Some sting more than others. If you lose it by a small amount or just terms,
that's what I mean.
That really stings. But what's happened more than that recently is that, we come in at a price that we think is reasonable, that makes sense, that makes it look like a good deal, and somebody just comes in at a price that like is just way over anything that we can be comfortable. And it's like,
that's the
good on you.
Yeah.
Go for it. So yeah. All right, Matt. Well, I really appreciate you taking us through the newsletter. I guess the last thing to mention is the latest post to the Gray Capital blog. It's all about cap rates and interest rate spreads, how the interest rates and cap rates interact with each other. So, after you're checking out the Gray Capital newsletter. You can hop on over to graycapitalllc.com/blog. Check the blog out. But if you're not subscribed to the newsletter, again, it's graycapitalllc.com/newsletter, graycapitalllc.com/newsletter. And if you are at all interested in viewing investment opportunities from Gray Capital, attending our members only webinars, getting all the exclusive content that we put out, you can join the Gray Capital Investment Club. It is also on the Gray Capital website, graycapitalllc.com. What is it? Is it join the club, or just go to graycapitalllc.com and there's a button, click join the club, and that'll get you all sign up. We do cool complementary investment strategy sessions. We can kind of walk through what type of target portfolio is right for you. Not based on just working with us. We encourage you to work with multiple sponsors and operators and build a really awesome, robust portfolio of multifamily assets, which we just did a webinar on portfolio construction, which, we'll probably post a replay somehow. I don't know if we can or not, but stay tuned for that. Stay tuned for more content. This has been a great episode of the Gray Report, a good review of the Gray Report newsletter. Thank you so much for watching, listening. Matt, thank you so much for kind of going through the Gray Report with us. You're doing a great job putting it together. If you're ever curious, who is kind of the man behind putting these together, it is Matt. He does a great job doing it. And if you ever have any questions, you can shoot Matt an email, matt@graycapitalllc.com. All right. That's it for the Gray Report today. Matt, thanks again. Have a good one.
Thank you.
And we'll see you all later.
Talk to you soon.
Bye.